The broadcast is now starting. All attendees are in listen-only mode.
Okay, welcome everyone to the latest tax-linked webinar. Today we're looking at current trends in mergers and acquisitions. We have a very special guest with us here, Chris W. Blees, who is a member of the Alliance of Mergers and Association Advisors, who we're collaborating with on this webinar. So let me get some admin issues out of the way before I introduce Chris. This webinar is being recorded. We will have a recording available within the next few days. We will also have a full transcript that we'll make sure to share with all of you. Also, those of you who are interested in submitting questions for Chris, we have a list of questions basically that have been submitted by our members. Some of them have been submitted by Chris too that we're going to try to cover. But if any of you have any questions that you'd like to ask Chris, make sure to use the control panel on GoToWebinar, submit the question, and I will make sure to include that in the discussion. So with that said, let me get started. I will introduce our panelists first, and then we will go ahead with the questions. So Chris is a CPA and middle market investment banker specializing in the sale of closely held companies to institutional buyers. Chris began his career with a 30-person CPA firm, Biggs Crawford, located in Colorado Springs. In 2004, Chris launched the firm's M&A practice known as Biggs Crawford Capital. In 2007, he was also appointed as the CPA firm's managing partner. Chris has become a leader in the M&A sector through his involvement in over 300 merger, acquisition, and sale transactions. Chris is active nationally in the M&A profession and was instrumental in developing M&A certification curriculum taught in executive MBA programs at Pepperdine, Loyola, DePaul, and Wake Forest universities. He is a member of the Founders Circle and currently sits on the board for the Alliance of Merger and Acquisition Advisors, headquartered in Chicago. Chris serves as the lead instructor for the Certified Merger and Acquisition Advisor designation, having personally instructed over 1,000 certified M&A professionals throughout the world. With this said, let me welcome Chris. Great to have you with us, Chris.
Hello, thank you.
And I guess let's get started with the questions. So the first question we have here from our members are companies currently looking to purchase others, or are they holding on to their money? What's the status in the market at this stage, Chris?
Well, yeah, I think the M&A markets are certainly hot right now. From all the measures that I look at and all the statistics that are being tracked, companies are trying to be acquisitive. They're trying to acquire. It's a typical function, I think, of the markets. The stock market generally rewards growth, and corporations have a difficult time growing organically, and so especially when the market continues to rise, that thirst for growth expands even more, and so you see companies that are driven to acquisition. So a couple tangible measures of that is a while back, PitchBook did a survey along with ACG, and they partnered up with ACG, and they performed a survey of all of essentially the Fortune 500, and found that Fortune 500 companies from over a 15 to 20 year period basically had zero organic growth. And so all of the growth that those companies ever encountered was all through acquisition. So I think large corporate entities know, publicly traded companies in particular know, that if they want to grow, they have to acquire. That's the only way they can grow. And so then annually, a lot of, especially the big four firms, Deloitte notably does the survey each year of corporate executives, CEOs, CFOs, and they pose the question, do you intend to be more acquisitive or less inquisitive than last year? Do you intend to pursue more acquisitions? I just looked at the 2018 survey that just was released by Deloitte. Their survey was 68% of corporate executives said that they would be more acquisitive than prior years. So going into 2018, private equity was 76% was saying that they would be more acquisitive than last year. Now, they say this every year, right? So, well, not every year. Going into the recession, those numbers were down, and so it was very few entities that were looking to be acquisitive in those 2009, 2010 timeframe. Today, and in the last 4 or 5 years, I would say these statistics have been pretty common. I think these are pretty close to the high water marks, though, of 70 plus or minus 70% of companies looking to be acquisitive, more acquisitive in 18 than they were in 17. Now, that's their desire. The question will be, will they actually be able to live up to it? And I know that leads to another question that you've got, but the fact is that they intend to be more acquisitive. They want to be more acquisitive. The question is whether they will be or not.
Okay, excellent. So I guess this is a good segue into the next question, which basically it's I guess a theory you have or an idea you have, because we interviewed Chris on TaxLinked prior to this webinar. We had a short interview with Chris, and in the interview you actually mentioned that the number of deals in the M&A sector has plateaued. You think it has reached some sort of stability, and in your opinion, why aren't more sellers taking advantage of the current market?
Yeah, so that's an interesting. It's an interesting analysis, and generally what you see in a lot of trends are, at least historically, when we've seen prior run-ups in the last decade, we saw a run-up in M&A activity, and we saw that not only were multiples continuing to climb, which you expect out of a out of a boom economy, you expect multiples to go up, but you expect sellers to respond, and you expect them to respond by selling. And what we are seeing today is we are seeing that multiples are climbing, like you would expect in a hot economy, and so from year to year, and you see corporations, you see private equity intending to be more acquisitive and to do more deals, make more acquisitions, and yet by most of the measures that I've seen, the actual volume of activity is plateauing. So the numbers of M&A transactions taking place are essentially flattened, and so looking at both private equity and corporate transactions, the databases that I've seen say that 2016 and 17 were both either flat or maybe even slightly down compared to we saw M&A volume, not necessarily multiples, but volume. We saw a plateau in 2015. So it's an interesting analysis to think, while valuations continue to go up, and of course this is a classic supply and demand problem. So we've got the supply, or rather we have the demand for acquisitions. There's definitely an adequate amount of capital chasing deals. There's the corporate motivation to do deals, but for some reason we are seeing that sellers are not responding. So I have a couple of philosophies or theories behind this, but no serious evidence as to why there are not more and more transactions taking place when there's certainly a desire and the capital to do them. So my philosophies are two. One is that I think a lot of the good mid-sized companies have been acquired, or at least have already taken private equity capital. Compare this to, for example, about 10 years ago, or even 10 to 15 years ago, the numbers of companies that had already taken private equity capital, there were still sort of untapped middle market size companies in the U.S. in particular, but even throughout the developed world. And so what has happened is, over that last decade, we've seen that private equity has been very effective. They've been out chasing these deals, and they have, in large part, bought up the market. Now, that doesn't mean that there's not an occasional middle market sized company that doesn't have private investment, but there are fewer, for sure. And the last run up that we've seen in let's say 2002 to 2007 timeframe, not only was private equity and corporations, not only were they chasing a population of middle market companies that were naturally growing into their middle market sizes, they were going after legacy companies that had existed for years and had never taken private equity capital. They were still privately held, owned by family members, those sort of things. So that time frame, though, exhausted a lot of that. And so now, going into this next boom cycle that we're in, I think the private equity firms are expecting that they could do the same number of acquisitions that they could do back in 2005, 2004, 5, 6, 7. But we're now going after a smaller population, and so because many of those private equity groups have already acquired, so we're only being able to tap into the new supply, if you will, the companies that have grown into the middle market, as opposed to those who had historically been there and just not taken private capital before. So I think that's probably issue number one. Is just a smaller supply than what the markets think is out there. The second is interest rates, and I think it's from a seller's perspective. Many sellers are saying, why would I sell today? What am I going to take my money? Where am I going to put it? That most investors would feel is safe. If you look at, even go back to 2015 timeframe, prime rates were 7-8%. So a seller could take their proceeds from the sale, reinvest that. Even if they were making prime rate loans, for example, they could be making 7-8% on their money. Today, that same investor is going to make 4% if they're lucky. And so I think the investment options for sellers is making them question, if I literally make half of the same money on my investments, what am I going to do? So I'm better off keeping my company. I know it's a nice steady rate of return. So we're seeing owners who historically everyone said, well, when these baby boomers hit their mid-60s, they're going to start exiting in droves. And what we're seeing is so many of these folks are just hanging on to their companies. They're not exiting, and they're going on into their 70s. And you talk to a lot of baby boomers, and they say, well, 70 is the new 60, and so on. but honestly, I think a lot of it is driven by economics, and I think a lot of them are saying, if I sold today, so what? I have $10 million in the bank. I'm used to living on or having a lifestyle of $1 million to $2 million a year. And how am I going to take this $10 million investment portfolio and generate that $1 million to $2 million a year cash flow stream? And you just can't consistently and safely.
Right.
So I think those are the two things that are sort of throttling back this volume anyway, despite the fact that we have a pretty hot economy.
Excellent. That actually makes perfect sense. I wonder if any of our listeners, what they think about it. So if you want to send in a comment, I'll make sure to share those with Chris on Chris's philosophies or theories. Next question. Now, just looking overall at, more specifically at the market, let's say, in your opinion, which will be the most active sectors in terms of M&As in 2018? What are the reasons behind this? Like, what sectors, what industries are seeing a lot of potential or are seeing a lot of interest in?
Yeah, so I think Bitcoin, clearly. No, I'm just kidding. Bitcoin.
There's a question just came in on Bitcoin.
Well, yeah, it's driving a lot of curiosity and questions in terms of the middle market activity. I think it's more of like everyone's slowing down to see the car accident that's taking place with Bitcoin. I don't know. I personally am not seeing any activity directly driven by Bitcoin. I think it's sort of an interesting phenomenon, and probably 5 years from now, even, we're all going to sit back and say, oh, that's what Bitcoin was doing. And that's the impact that it had. I can't tell you today what I can't predict what that's going to be. But again, like I said, in 5 years from now, we'll all be able to give a historical lesson on what happened.
I guess,
but
that's
I do think, I think from a traditional markets perspective, I think the activity that we're seeing, number one, is healthcare. Healthcare is for a lot of reasons a very active marketplace. I think we're seeing that from the rising costs of healthcare, for one, the technological requirements that are getting plugged into healthcare. So a lot of healthcare tech is really becoming quite attractive. And then I also think the aging population is driving a lot of those healthcare things, and when you get into senior care and senior care facilities, but even a lot of just general healthcare, as population ages, there's greater need for healthcare. So we're seeing a lot of activity in healthcare, tech-driven healthcare, ways of helping control costs, helping control the billing cycles. Anything that touches healthcare has legs, and I think that's again a function of a lot of those economic issues. The second area is technology, and that's always been the case, and we've always seen technology. But I think technological advances, and I think large technology firms in particular, we see they have sort of adopted this growth by acquisition strategy long before everyone else. Other industries perhaps have driven their growth, and if you want to use as an example the automotive industry versus tech industry. When's the last time an auto manufacturer acquired a small growth startup auto manufacturer? That just doesn't happen, right? We don't see what we see. Instead, we see the automakers develop their own vehicles. We see them making their own technological advances, and maybe Tesla is about the only example that we could see of an auto manufacturer that has actually come out of the ground and begun to compete in the market. So that is a good example. Whereas take Cisco Systems or Google or Amazon or Microsoft, even any of these tech giants today have only got where they are today based on acquisition. I mean, we can look at the platform we're talking on right now, this GoToWebinar, which is a Cisco product, I believe. Cisco didn't invent this. They didn't create this. They bought it, and so that is how these tech firms have grown. Is they've grown by acquisition, and they continue to grow by acquisition. So while the market heats up and while acquisitions grow, what you'll see is, I think you'll see a lot more activity in tech because that's how the tech companies grow. And you look at Amazon today, and tech is no longer about just doing computer supplies. And Amazon, if you recall, I think started in the book business, and they are now basically, they're in any industry they want to be. In fact, I think they're going to cross over into healthcare now and start acquiring healthcare companies. So I think the acquisitions coming out of tech are going to be are going to continue. They're also going to get hotter, more expensive, higher valuations. The last area that I think going into 18, I think we're going to start to see more consumer-oriented, consumer-facing acquisitions. And this is an interesting trend I looked at, was that over the course of history, if you go through boom and bust cycles, that consumer-facing activity generally only heats up when the economy is heated up and when we actually see a consumer-led recovery. The last 4 or 5 years of this recovery have not been consumer-led, and we're finally starting to see consumer spending. We're starting to see consumer-oriented activity going up. So things like retail, restaurants, and consumer-oriented business activity is finally starting to kick up. And so I guess we will also see, I'm suspecting that in 18 we're going to start to see an uptick in consumer-facing acquisitions as well.
Excellent. Thank you, Chris. Thank you for that very comprehensive answer. Now let's go back to, I guess, to those listeners out there, I got several questions about the new tax law. We're getting there. We're going to cover one more question that Chris had actually submitted in his interview, and then we'll get into the tax-related issues, mainly with the latest tax reform in the U.S. So in the same interview that you participated in with TaxLinked, you mentioned that you believe there will be a bubble forming in the sector. Will the M&A bubble be caused by an overall correction in the rest of the economy, or will it just be isolated to the M&A markets? This is something that you brought in the interview. You want to discuss a little bit that?
Yeah, so I think generally, anytime you see valuations climbing, there's a bubble forming. I mean, that's just obvious. And so we are in the middle of this now, and I think we're going to see that we are seeing a bubble forming. The question is always, when does it burst? How dramatic is it when it bursts, and so on. So my philosophy is that most of the M&A bubbles that have been really dramatic are the ones that coincide with a general downturn in the economy or some overall economic downturn, economic bubble. And from most of the economists that I have listened to, we don't see that bubble in the overall economy forming. Nothing of a dramatic size like we saw 2008. So I think the reality is we see multiples for M&A at an all-time high. There's probably a correction on the horizon. So I suspect that if we do see a correction in the near term, in the next year or two, it's going to be a mild correction, and it'll be specific to the M&A markets only. Maybe a slight downturn in lending, a slight downturn in access to capital. Maybe everyone's going to be buying Bitcoin and no one's going to have money left for making M&A acquisitions. I don't know. But that will have a mild impact on the M&A activities and multiples versus if we saw a significant economic downturn, something that catastrophically affects the entire economy, which, again, most economists don't believe will happen for a couple more years. So if we follow that trend, I think we've got a couple more solid, good years of M&A activity here that I expect to see. I expect to participate in. So I'm an optimist that we have a couple more good years.
Of course. Since you mentioned Bitcoin a few times, we have a couple of questions on Bitcoin. I'm gonna just throw one out there,
Sure.
just to see, basically one of the questions is, what are the risks of acquiring an entity with an undefined and not regulated source of funding, or Bitcoin, essentially, virtual currencies? What are the risks? What are the risks in, participating in M&A transactions using that type of funding?
Yeah, well, I'm not by any means an industry expert on this. At the last conference the AMAA held in Miami, there were a few sessions on Bitcoin and other cryptocurrencies. From what I'm gathering is this is the absolute Wild West of the acquisition world, and so I think. Certainly traditional lenders are not necessarily comfortable in these spaces yet. And so I think you're going to see either huge opportunities or you're going to see huge risk. And I guess the two, depending whether you're an optimist or a pessimist. So maybe in that regard, I'm a pessimist because I'm avoiding my own activities with Bitcoin. I'm not buying in on it. I still think that there's unknown risks, which who knows what those could be. But I think all it takes is one great hacker to come in and figure out how to bust Bitcoin, and just one little bad announcement like that, and we could see a downturn in some of that pretty significantly. So those are my concerns with it. So I'm personally avoiding that.
Okay, thanks for that, Chris. Okay, with that said, let's get into the tax component of the presentation. We're about halfway through, and just to get us started on this discussion on tax, what are some of the main tax-related issues companies must take into account when involved in mergers and acquisitions? Just a general kind of introduction to tax and M&A.
Yeah, so you can really boil it down to whether you're on the buy side or the sell side of the equation. If you're on the sell side of the equation, if you're selling, and in particular a private company, a middle market sale, whether that's being sold to a larger public company or sold to a private equity firm, either way, the seller's general motivation is how to maximize their after-tax proceeds, and the most common issue that's encountered is capital gain versus ordinary income. And so in the U.S. tax code in particular, it's a matter of minimizing the ordinary allocation of assets, or allocating less to ordinary income tax, and creating more capital gain in lieu of ordinary income gain. So that's generally on the sell side. Now, opposing that on the buy side has traditionally been the goal of creating tax benefits and assets that can be amortized or depreciated going forward into future years, and helping offset their profits, and therefore enhancing their rate of return. So it's not a complete give and take, but in most cases what we see is the goals of the seller to have maximized their capital gain is offset by the goals of the buyer to be able to maximize their depreciation of what they've acquired. So those are sort of at a high level the general the balancing act that takes place between buyer and seller.
Excellent. Thank you, Chris. Okay, now since we've received this question already from a couple of the listeners, let's look more specifically at the Trump administration's latest tax reform. And basically the question is, how will this latest tax reform affect M&A in the U.S.?
Yeah, so I think the biggest impact is related to the 21% corporate rate. Obviously, a huge impact to the tax law in general, and so the way I've boiled this down is that there's a few different ways to look at this. The first is looking at the 21% rate from the impact of the buyer's perspective. And what's interesting is what it has done from the buyer's perspective is that potentially, or at least in some fashion, it has reduced the buyer's desire for assets. So we're back to the general buy side scenario, which is to maximize their depreciation and amortization benefits. And those still exist, except they're just less valuable. So instead of providing a 35% deduction and saving 35 cents on the dollar for taxes, it's now only 21 cents. So it's just slightly less valuable. On the flip side, what this 21% rate reduction has done is it has significantly changed the lexicon for determining, is an asset deal of a C corporation, is it now more palatable for a seller than a stock transaction? And again, traditionally going into an acquisition or a sales scenario for a C corporation client, the common logic has always been, we need to figure out how to get this done as a stock deal, because the asset deal is going to be very painful. Well, it's now still more painful than a stock transaction, but it's less painful. The other comparison is to a flow-through entity, and this goes into entity selection, goes into advice that we give clients leading up to a transaction. So in the years prior to a potential sale, do we advise clients to make an S election, to become an S corporation, to become a flow-through entity? So those choices now are, again, an asset sale inside of a corporation, a C corporation, is now less painful. One of the colleagues of mine in Miami, when we were presenting there, he came up with the term, it's less worser than before. Now, it's still worse. It's still not better. It's now not immediately do we go tell all of our S corporation clients that they should convert back to C corporation. That's probably not the right answer, but it certainly is less worser. And so, in fact, I ran some scenarios and in the presentation I gave in Miami, the difference in after-tax results, something in the range of about a 13 to 15% is in 2017, if you had sold assets of a C corporation versus assets of an S corporation. And the difference in after tax was about 13%. So that's a pretty sizable gap. I think that gap has now dropped to maybe 5%. So, again, depending on the facts and circumstances of the case, but it's roughly somewhere between 2 to 3 times better, or I guess maybe a third of somewhere between a half and a third of the problem has gone away. Now, that doesn't mean there's still not a problem, and so you still have a worse situation generally in selling assets of a C corporation. But again, maybe now we are less motivated, or the buyers are less motivated to seek all asset deals because again, the tax benefits to them are not as bad. So I think we maybe have more flexibility in today's market, in today's tax law. I think this lower rate's given us a little more flexibility in being able to negotiate with a buyer about whether this should be a stock transaction or an asset transaction, and the consequences are less dramatic. And so those are all elements that I think have potentially made our jobs easier, in the sense that from a tax perspective, we don't have to always be the bad guy at the table. We can maybe roll with the punches a little better, and the bad news that we have to give to someone isn't as bad. So that's probably the biggest impact. A couple other smaller impacts that I think will either drive more M&A activity, or we need to be taken into account. The first is with respect to Section 1202, and this is actually a fundamental difference that was created even back 2016 or 17 timeframe. Section 1202 is the complete avoidance of tax for small C corporation sellers, and when they sell stock. And again, there's a number of requirements to qualify, but one of the problems had been that there was still an alternative minimum tax, an AMT problem, and that went away. I believe it was the 16 or 17 tax law that eliminated the AMT preference item. So while that probably wasn't a huge impact, all of a sudden now today with a 21% tax rate, I think our advice to clients as to whether they should start out as a C corporation or as an S corporation is different. And I think it's worth another series of thinking and another session of discussion. I would anticipate we're going to see a lot more startups coming out of C corporations today because of a combination of the lower corporate rate mixed with the potential of using 1202 on the back end when they sell. Other little things that I think the bonus depreciation maybe overlooked a little bit by everyone looked at that as a driver for making capital investments and making corporations have 100% bonus depreciation, allowing them to completely write off their acquisitions. What's sort of important for the M&A community is that they also allowed, and this is the first time for bonus depreciation, they're allowed used equipment. So clearly, an M&A transaction is used equipment, or if you're acquiring assets. So what this means is that the entire asset allocation to equipment in an acquisition, an M&A transaction, could be completely written off. To me, that's huge. I mean, that's a very significant change that impacts the way asset deals can be structured for tax purposes. That a large part, and especially if we're talking equipment-heavy type of acquisitions, we could see those being very tax motivated to be done as asset deals, and that where again that was traditionally a 5 or 7 or longer period of write-off. I think we're going to see corporate entities wanting to take advantage of a one-time write-off of a good chunk of their asset purchase. So those things. There's a couple other provisions in the law. The way that the 20% flow-through deduction is going to work, that will have some impact on our M&A transactions. It will certainly have an impact on those entity selection discussions that I think we have with clients on the front end, but also on the back end on the sale. There are a few other provisions, namely some loss limitation provisions that might impact how some transactions are done. Probably we'll talk about that more when we see a downturn and when we start to see distressed sales taking place. We're going to see some of these loss provisions maybe kick in. Nobody talks about losses when the market's going up. So, but someday those will become important provisions we're going to need to learn. And then there's this new interest deduction limitation is important for heavily leveraged buyers. It's something that they've never had to model before, and we're going to have to weigh in from a tax perspective. We're going to have to weigh in on the deductibility of those. So those are, I think, the biggest impacts that I can see.
Excellent, thanks, Chris. We have actually a follow-up question on the tax which just came in, and it basically says, what about DCF valuation on the tax rate? Will buyers be using the 21% in their DCF models? We are hearing buyers wanting to absorb higher returns. What are your thoughts on that?
Yeah, so I'm sorry. So using the 21% rate in their DCF models, was that the question? Yeah.
Yeah.
So
basically, yeah.
Yeah, absolutely. I do think that valuations, and I've done some modeling on this with one large corporation in particular that I've now sold a couple companies to, and they in my transaction discussions with them were absolutely using they were using the higher corporate tax rate in their DCF modeling. And in fact, in one of the transactions that the business development executives shared with me his exact formula and said, here's the formula I'm using for determining the valuation. And I took that formula after this tax law change, and just by substituting the 21% rate for the 35% rate, the effect on the purchase price was about a half a turn on the multiple. So what was a 4.5 multiple becomes about a 5.2, 5.1 multiple. So it's about a 0.6, 0.7 impact on that size. If you're in the 6 or 7 multiple range, you're probably more at about a half a turn on your multiple when you're up in the higher valuation ranges. So the fact is, absolutely, I would expect that corporate buyers in particular, in their modeling, they are absolutely using corporate rates. They're doing after-tax modeling for establishing value, and so it's just math. If you substitute 21% for 35, the net result that I found is about a half a turn on the multiple. So I think valuations will take an uptick from corporate buyers for that, and then as a result, private equity buyers are going to have to to compete. They're going to have to increase their multiples. So all in all, I guess that could have a negative impact on returns for investors in private equity. Then again, maybe that's made up because on the back end they're getting higher valuations when they sell their enterprises. So I don't know the rate of return impacts that has, but to the specific question about modeling around values, absolutely. The answer is absolutely. They're using after-tax modeling for their DCFs.
Okay, I have another follow-up question on the DCF calculation. So on the DCF calculation, do we anticipate the after-tax cost of debt portion of the WACC, the WACC, to be recalculated in light of the new tax laws?
I think you have to. I think that when you're talking about a corporate acquirer again, I think you have to tax effect, and you have to use today's tax rates. The real question is going to be, are you going to also change that weighted average, the cost of capital with respect to individual or flow-through entities? And I think there is a slight reduction in rates there if they are a qualifying company for the 20% deduction, that further reduces the rate. So again, there's a lot of nuances here, and we now, for the first time, have a significant difference maybe between our corporate tax or federal tax rate and our flow-through entities, where before, if we sort of assumed a 34% corporate rate, we kind of said, well, maybe individual tax rates are kind of in the maybe upper 30s, so we're only off a few percentage points. We could sort of use a common number. Today, if you're going to use 21% for corporations, do you still use 35 to 40% for your individual owned companies for flow-through entities? So these are all questions I think are going to be debated. Good luck to all of you in the technical valuation world. Not the world I spend my day worrying about, but I'm sure a lot of you smart guys that love to do those WACC calculations will enjoy that, and then there'll be lots of good sessions at your valuation conferences.
Excellent. I have two more, I guess, follow-up questions on DCF. I will read both of them, Chris, and you can tackle them as you see fit.
Sure.
The first one is, would there be a valuation hit in the DCF model for the new interest expense deduction limitation? That's the first one. And the second one is, how should tax depreciation in DCF be handled with the ability to expense?
So good questions. I think I'll address the interest one. I don't think that one's going to have as much of an impact. You've really got to get to a pretty sizable interest impact, and you've got to be pretty highly leveraged for those limitations to start to kick in. So I don't know that most of the companies that I see, even when they're fairly highly leveraged, those don't kick in unless something bad happens, meaning that there's a serious downturn in the profitability of the company, which then ends up triggering the interest limitations. For the most part, I think nobody's going into levering up a company with the expected limitation on interest. If there was, it would be pretty simple to model. So I don't think that's a big of an issue. And nobody's modeling, 5 years out, modeling a downturn in their DCF model. So I don't think that's probably not the one that'll have more of an impact. On the other question, I think it is realistic that we look at the depreciation impacts now of an acquisition, and I think that is absolutely part of the tax calculation that buyers are taking into account. So their ability to write off on day one a significant part of the purchase price, absolutely, I think that should be baked into your DCF calculations, because and will have a positive impact on value, as will the 21% rate. So I think those do need to be taken into account, because it will accelerate their real tax benefits.
Excellent, thank you. Thanks, Chris. I have a couple more questions here. They keep rolling in, so this is good. It's good because we have another 2 questions left from our list, but I'll include the ones that I'll go first with the ones that we've received from our listeners. So the question is, on interest tax deduction, do we anticipate GAAP accounting treatment of interest changing to be more in line with the new tax laws? And if not, would that impact increases in deferred tax assets from the GAAP accounting perspective? I don't know if that's clear.
Yeah, so I do think it'll impact deferred tax calculations. I don't see there being much of an impact from the way GAAP accounting is done around interest itself. I think it's sort of similar to the way this interest expense limitation is put in the tax law. It's very similar to the way charitable contributions are put into the tax law. And again, if you look at how GAAP has treated that, for GAAP purposes, it's still a deduction in the year that it's incurred. The only impact is whether or not it creates a deferred tax asset, and then whether that deferred tax asset is impaired or not has to do with whether we believe that the company will eventually get to use these deductions. So I think to the extent that that a company does end up in an over-levered position, ends up having a downturn, a year in which its interest expense is limited, it's probably anticipated that it will get deducted in the future, and so clearly there should be a deferred tax asset created. So I think that will now become part of the deferred tax calculation, like any other carryover deduction.
Excellent. Thank you, Chris. Now going back to one of the last questions that we have from our list, at least, and we got something similar from the listeners too. It's basically this, you can take a look at more from a global perspective, not as, I guess, US centric, but how will lower corporate tax rates impact valuations in 2018, or more in general, how will lower corporate tax rates, because this is a trend right now throughout the world that couries are actually reducing their corporate tax rates. How will this actually affect valuations or the M&A sector?
So I think there's two parts to the international impact of this. The first is the overall rate reduction, and we talked about that, and I think I do think there's an impact there. I think that the lower overall tax rates, corporate rates here in the U.S. in particular, it's very clear. You take 35% tax rate, you drop it to 21, plug it into the exact same after-tax DCF calculation, and you get a bigger number. And like I said, I think that impact is somewhere around a half a turn on a multiple if you boil it down to a multiple of earnings. So I think whether that's the U.S. tax rates or whether that's foreign tax rates, it doesn't matter. If you lower the corporate rate, you lower the tax burden of those future earnings, you will get a higher valuation. That's just math. I think there's another interesting factor that is going to take place because of this latest tax reform, and this has to do with both transfer pricing as well as M&A activity from repatriation. And what we're seeing already is large corporations announcing big repatriation back into the U.S. I read a few articles on this, and one of the articles from a little more liberal perspective was that this isn't going to work. We tried this before, and in fact, if you look back at 2004, there was a repatriation holiday that was given to corporations, and what all the analysis said is it didn't work. And what they mean when they say it didn't work was they said that, well, they didn't hire more people. The corporations repatriated this money, and all that they ended up doing was declaring dividends, paying down debt, and, oh, by the way, making acquisitions. So, which to the politicians anyway, the politicians say, well, that's not what we wanted to happen, therefore it didn't work. Well, I wanted that to happen. I like acquisitions taking place. I like debt getting paid off. Debt getting paid off means lenders have more money that they need to redeploy, which means more acquisitions. So to me, while it may not have done what the politicians wanted, it didn't maybe result in more employment. It didn't spur hiring or capital investment necessarily, but it did actually stimulate M&A activity. So I think that this repatriation we're going to see, and maybe more specifically internationally, it's not just about repatriation back to the U.S. It's about making funds more mobile, making them more transferable between tax jurisdictions. So what we see is the impact here in the U.S. I think we're going to see M&A activity benefit because of this repatriation, but we're also going to see transfer pricing becoming less of an issue. We're not going to have, now that the U.S.'s market rates are a little bit more in line with the rest of the developed world and other developed countries in line with each other, this whole game of transferring, nobody, I mean, I'm sure there are corporations that will play games over 2 and 3%, but less than 15 or 20%. So when we see these transfer pricing issues become a little bit more on par with one another, I think we end up in a world where M&A activity benefits, because now you can make an acquisition in the U.S., you can make an acquisition in Europe, in Asia, you can make acquisitions across the globe not based on, oh wait, we have to first figure out how to get the money over there, and we have to figure out how to repatriate it, and then we have to figure out what kind of taxes we're going to have to pay by putting our money in that country versus this country, so on. Those are eliminated now. We not eliminated, but they are far reduced, and so I think we're going to see much more portability of funds, portability of capital, and therefore ease in deploying capital where it makes sense, which means M&A activity benefits. So to me, those are the reasons why I think this latest change in overall corporate rate reduction, and in particular the U.S.'s rate becoming more on par with other nations, is going to benefit the M&A activity. That's my take on it, again, from an optimistic M&A perspective.
Excellent. Thank you, Chris. I have here another question that I actually saved for towards the end of the discussion. This goes back to your comments on Amazon earlier in our discussion. Do you feel companies will go back to the late 21st century conglomerate portfolio per your Amazon comment, or continue in specialization with more vertical integration in the future? What are your thoughts on that?
Wow, that's a Harvard MBA question if I ever heard one. I'm sure someone at Harvard could make their entire thesis around that question. I think that the concepts of Amazon, I think, are a bit of an anomaly, frankly. If you take aside the huge impacts of Google and Amazon, probably most notably, and you look at the rest of the economy. So we're not all running Amazon and Google in our businesses. If you look at what the general marketplace benefits from, the general marketplace still benefits from being a niche provider, meaning you do what you do really well, you leave the other parts to someone else who does those parts really well. Even the auto manufacturers do this. Toyota is no longer an auto manufacturer. They're a final auto assembler and a marketing company is what Toyota is today. So and what they do is they outsource everything. Everything is made by different providers, from the front bumper to the seats. And so what I think is going to continues to be, from an economic perspective, the right answer and the advice that we give to clients from a business perspective is, don't try and be a conglomerate. Don't try and take over the world, and boil the ocean, if you will. Focus on your niche. Be very good at your niche, and you'll be rewarded for that. And then outsource or find others to partner with to handle other things. So I don't think the rest of us in sort of the real world should go follow or emulate Amazon's approach of maybe Amazon will be successful in boiling the ocean, but I think you can count the number of companies that can do that on one hand.
That actually makes perfect sense, Chris. Okay, so we're almost at the tail end of our discussion. Let me throw out one more question there. This is from one of our members, and it has to do more with the human side of M&As. So when it comes to M&As, are consulting firms also advising on, like, say, human resource due diligence, or do they still consider the human side of M&As as a collateral damage to be included in the forecasted profits and losses? Basically, when you have an M&A, what happens with your employees in the companies? I mean, are they collateral damage, those that lose their jobs, or are they including these in the risks and so forth? What are your thoughts on that?
So, in general, I will tell you that buyers are absolutely concerned with transfer of employees. Most of the transactions that I'm involved in, and especially the technology companies that I'm involved in, the human capital is the asset they're buying. So it's sort of like, you're not going to go make an acquisition of a piece of real estate if you're without checking the fact that piece of real estate would have a tendency to flood and be destroyed, right? So you're going to do your homework. You're going to do your due diligence, and likewise with an acquisition of a human capital intensive company. Any buyer that view that as the asset they're buying, they're going to do a lot of due diligence around it, and they already do. And they spend a lot of time evaluating the culture, evaluating the workforce. What's the likelihood of that workforce being retained? And so they're not making acquisitions with the intent of how many of these people can we eliminate. They're making the acquisition with the intent of how many of these people can we retain, because that's the asset we're buying. So that's the answer for the general workforce. The folks on this call, I would bet, tend to be financial professionals, and those financial professionals fall into a different category. We are not the assets that a buyer is looking to acquire. Unfortunately, we fall into the category of collateral damage. So yes, sometimes the financial professionals and the executives teams, other executives as well, are the collateral damage of an acquisition. And I tend to see this most frequently in the CFO and accounting categories. Those professionals, yeah, that's the unfortunate reality of M&A. Sometimes is that when you have two companies or one company acquires another, they don't need a senior CFO executive. Maybe even can eliminate some other accounting positions. That's the bad news. The good news is I have yet to find a good quality CFO or controller that can't find a new job in about a day. So, and in particular in the market we're in right now, if you're displaced because of an M&A activity, send me your resume. I'll get you a job in about a week, because it's just the number of open positions in that area far outnumber the number of people getting displaced because of an M&A transaction. So I don't think it should be something to be too concerned with. In either case, either if you are a critical operator of a company, then you're fine. That's what the buyer is buying. They're buying you, and they're buying your talent. If you are an executive and you happen to be part of that collateral damage, yeah, that's one of the negatives. But at the same time, I think there's enough demand right now out there for quality financial professionals in particular. So, you can get another job.
Excellent. Thank you, Chris. So we have 3 minutes left. Any concluding remarks that you want to leave our listeners with on the current, I guess, status of the M&A world?
Yeah, I mean, the overall conclusion is this, and that is that by all measures, multiples are up, and they were up before this tax law change. So we were seeing those trends were headed upwards, and those are driven by normal economic cycles. We see the stock market's up. We see corporations are flush with cash. We see lenders are finally coming back around and lending at multiples that we saw 10 and 12 years ago. So all of those activities were happening before we had a tax law change. So what happens? We now have a tax law change. All that does is pile on. And so the tax law, I think, by and large, with the exception of a couple little pieces that might, like the interest reduction, there are very few areas of this new tax law that would slow down M&A. 98% of this new tax law is going to accelerate M&A. So we're putting frosting on top of a really nice cake, and the overall market was already driving increased multiples, increased M&A activity, and now we have a tax law that is putting icing on top of that. So I am very bullish of the impacts of this in 2018. I hope 2019, maybe 2020. At some point, this is going to get frothy, and we're already frothy. The question is how much more of this before we see a real bubble burst. So those are my overall takes on this. Is that this tax law is it's icing on top of what was already a really healthy M&A environment, or maybe even excess health environment. So we're going to see more of it. We're going to see a lot more M&A activity in the next years to come.
Excellent. Thank you, Chris. So on behalf of TaxLink, I want to thank Chris for this, excellent and very insightful discussion. I think you covered almost, 16 or 17 questions, most of them submitted from our listeners. So I think it was very, very useful to all of us here. Just to get some admin issues out of the way before I say goodbye, this webinar has been recorded. We're going to have the recording available within a few days. We'll make sure to pass those on to all the listeners and to our community members. We will also have a transcript. The full transcript will take a little longer for us to get out, but once we do, we will make sure to share with all of you. Also, I think Chris is going to send me a presentation that he put together on some of these topics, and I'll make sure to put those in the community and send it to all of our listeners. So with that said, on behalf of TaxLink, Chris, I want to thank you very much for taking the time for participating, and hope you all have a great week ahead.
Okay, thank you, everyone.
Thank you. Good night. Good morning. Bye.